For Planning and Control is the name of the chapter. A few of the objectives we'll talk about. We'll talk about what budgeting is, some definitions, lots of definitions in this chapter. Planning and controlling, or a couple we'll talk about right away. There's all kinds of budgets within a budget. We'll talk about what those are and the interrelationships between them. We'll talk about financial budgets, cash budgets, operational budgets also. Some other topics will be flex budgeting. I'm going to skip activity-based budgeting, so we're not going to spend much time talking about that, and then we'll talk about just kind of the behavioral issues surrounding budgets also. So in your book, the first page is on 376, 377, and just some definitions right away. The very top of 376, they talk about what a budget is and what control is. So budgets is quantitative, just think numbers. Whenever something is quantitative, we're talking about it numerically. So it's a numerical plan for the future. Here's what we expect to have our financial statements look like a year from now. And that can be measured both financial, which is kind of what we're used to, or physical too. So it could be volume of units. That could be a goal, is to sell so much, or a head count for university enrollment. You know, there's all kinds of things like that. So both physical and financial. Control is a process of setting a goal, and here they call it a standard or a goal, a budget, whatever that will be, and then saying, okay, if that's my goal, how am I doing getting to that goal? So if I'm outperforming that goal, great. If I'm not outperforming that goal, what are some corrective things I can do to achieve that goal? So it's a process of having a goal, measuring how we're doing achieving that goal, and making decisions, as they say, corrective action to get there. So that's the control piece of it. Bottom of page 376 has the same chart that you see right here. So really what happens first is planning and strategic planning. And typically that's, your higher level executives basically saying what's kind of the big picture of the business we're in, of the industry we're in. And based on that, kind of what are our long-term goals? A lot of businesses will have a 5-year kind of a rolling goal saying in 5 years, this is what I want to achieve, this is what I want to look like. But within that long-term goal, you'd have a series of short-term goals. I mean, typically you're looking kind of a year out, because a year you can control to a certain degree. It's easier to predict 1 year than it is for 5 years, obviously. And so you set, within that big picture strategic plan, you set up smaller objectives, right? So you've got your long-term objectives, you know what those are. But basically you're saying, okay, I need a series of shorter-term objectives to obtain my long-term objective. And so whenever you say, we've got this strategic goal of doing something, what are the things I should be doing now to help me accomplish that 5 years from now? And that's a lot of what a budgeting will help us to do. So you can see we've got the bottom is operations, production, service, sales, just the things we're doing on a daily basis to make money as our business. And of course, that has to fit into the long-term objectives. There's several short-term objectives beneath that. And budgets help us get there, right? And that budget is comparing actual results with planned results and trying to figure out why did or didn't this happen the way we thought it would. So the purpose of budgeting, and there's lots of purposes for budgeting. 4 of them are right here. They're also listed on page 376. Forces managers to plan, right? I am forced to come up with a plan now. I have to share that plan, talk about it. As I talk about it, I can refine the plan, discover what other plans are, and see how my plan fits in with the bigger picture of the operation. Provides resources. Provides resource information, I should say, to improve decision making. Right, as I plan, I need to find information to come up with that plan. Aids in the use of resources and employees that can be used to evaluate performance. Standards or goals can be brought down to practically anybody in a business to say, if we achieve these goals, there could be a bonus or whatever it is, or something in it for you. Improving communication and coordination. So it's to try to make sure that there is a plan, you're forced to plan. It's to provide information. It's to allocate resources. Every business has finite resources, so we have to decide how will we use those resources to achieve our goals and make the most money, basically. And then talk about communication and coordination. That's why you have budget meetings, you have maybe a kickoff, you have strategic plan meetings. Basically, it's just providing information to say, here's our company's goals, and here is your piece in that goal. If you do your job correctly, we'll achieve these goals. Well, your part of it will be achieved. You can get a bonus for that, and so on. Now, of course, that's the ideal way to do it. Does every business do it that way? Probably not, right? We can probably all think of businesses that are probably fallen short of that. So the budgeting process, page 377, they begin to talk about this. Just so you know, I spent of my 20-ish year career in finance and accounting, probably about 15 years of that I've spent working on budgets. I've been a budget director at a very large company, and now that was in my non-academic life, but even in academics now I am, the way USF does budgeting is, because I'm ahead of a program, I have a budget, so I budget for certain things. This upcoming year, I'm going to be the faculty representative on the budget committee at USF. So I've never been a part of the budget committee at USF, but I'm going to be the faculty rep here for the next 2 years. And having been on a budget committee in a private for-profit business, I can just kind of give you my perspective from that. But basically what you're doing is you're setting goals, you're meeting with all kinds of people, you're talking to the folks who put together a strategic plan. You're getting a sense for what needs to be accomplished this upcoming year to fit in that plan. You're meeting with the sales department. What are you thinking? What's your goals this year? Are going to be rolling out any new product lines? How are sales going? What's your expectation for sales next year? You're looking internally at your costs to do business. Are our costs rising? Can we find some efficiencies? Things like that. You're basically gathering people together, meeting typically by department, and kind of going through, here's what we're looking at this year, here's what we're seeing. So when you turn your budget in, here's just some general guidelines to be thinking about. And you're kind of that go-to person to help answer questions when departmental managers are putting a budget together. And of course, kind of once you get your initial roll of budgets in, you put them all together, see how that rolls up to the big picture, and of course you begin to make changes and adjustments and have conversations with departments saying, what we're seeing is you can't budget this much for salaries, you're going to have to make a cut, or whatever it is. That's what's happening. And then ultimately, once the budget's put together, then you're monitoring that budget. You're issuing reports on a monthly basis, comparing, here's what your actual was versus your budget. Here's a variance, here's your last year's actual numbers for some history, and then basically putting together information to say, explain any variances over a certain percent or dollar amount. Why is that? What's going on with your department that you've got this budget variance? Explain that to us, and you have regular meetings to kind of talk about those. That's kind of just a big picture of what a budget committee does. So there's different types of budgeting. When you think about budgeting as you and I as individuals, we kind of just think, okay, money in, money out, right? I get paid twice a month or whatever it is. It's X dollars per month is what comes in, so my expenses better be below that, right? You can kind of know what your regular expenses are every month if you've got a mortgage or rent or various insurance payments, car payments, utility bills. You kind of know what those are every month, and of course. Then you've got the discretionary spending, how much for entertainment, well, I'm going to save up for a vacation or save up for an improvement to my house, whatever it is. We're kind of always thinking like that as individuals. And businesses are no different. You have to budget, but businesses budget not just for revenues and expenses, but really for everything. So you're budgeting what the master budget really is a financial plan made up of various individual department activity and budgets. So there's a lot of budget within a budget type of going on here. And so we'll kind of talk about those. So an operating budget is more income generating, and the financial budget is more dealing with your cash. What's your cash coming in, what's your cash going out, and what's your financial position. But you can literally budget for every financial statement, and those financial statements are your income statement, statement of equity, balance sheet, and cash flow. And so just know you could do that if you can take it that far if you would like to. Where I was in a budget role for the longest, that's what we did. Everything got budgeted. You had a full set of budgeted financial statements based on a bazillion assumptions that went into it, but you ultimately produced, here is, if our plan comes true, here is my budgeted income statement, my statement of equity, my balance sheet, my cash flow. Here's what's going to look like this upcoming year. Now, some businesses that are small may only focus on the cash budget. Obviously, seasonality plays a role with a lot of businesses, and so if you have a seasonality issue, your cash in and your cash out could be very different in timing, and you do a cash budget to try to figure out, okay, I know some months I'm going to be short cash, I know some months I should be long on cash, but what do I do when I'm short? Do I have a borrowing plan in place? How do I cover any shortages I may have on a temporary basis? So we'll talk a little bit about cash budgets, and then you've got what they call the rolling budget, just basically a moving 12-month budget. And I've never actually been in a business that does it, but basically what you do is you drop the old month off and you add the new month. You're doing a budget every month. You're kind of just saying, okay, here's what we expect this upcoming month based on the information that we've got now. We dropped the oldest month off and just got a rolling one-year budget. So that can be done. Obviously, that would take a lot of work. So I've never been in a business that did it that way. On page 378, you'll see what's on your screen here. With this one, it's kind of hard to see in the video here, but you might just want to look at it in page 378. So when I talked about you've got a lot of budgets within a budget, this is what I was talking about. So now this is really from the perspective of a manufacturer. And so when you've got a manufacturer, you've got a few more things to kind of be concerned about. You could do the same thing for a service company or a merchandiser, but you wouldn't have the level of things to be concerned about in budgeting because a manufacturer is making a product. So now we have to worry about direct materials, direct labor, and overhead. A merchandiser is buying finished goods already, and a service company is not making something, so you don't have to worry about direct materials. So just know that we'll look at a manufacturer just because it has all possible components in it. But just kind of look at what we're going to have to kind of look at and figure out here is you always start out with the sales budget. That's really the foundation for any budgeting. How much will we sell next year? And based on what we anticipate sales to be, will be the production budget, right? If I'm going to sell 10,000 units of a good, I have to make sure I've got that many available to sell. I have to produce that many to sell them. And so once I know how many I have to make, now I can figure out how much raw material do I have to buy for direct materials, how much labor will I need, and how much overhead do I think I'll incur to manufacture all that. Obviously, when I'm done making my good, I have ending finished goods inventory. I want to budget for that. Then I would sell my good, which is cost of goods sold, which would help me produce an income statement, which will use my sales figures and my cost of goods sold. But I also have to worry about all those administrative expenses like marketing, administrative, research and development if I have that. So those all play into the income statement also. Okay. Then down here I've got a cash budget, right? All these things that were just looked at are going to require cash, right? I've got sales with cash coming in, but I have to buy raw materials. I have to pay for overhead. I have to pay for direct labor. I have to pay for all of my administrative expenses, right? Cash in and cash out. What's my cash budget look like? To give me and then that would help me get to a budgeted balance sheet and a budgeted statement of cash flows. I also have to think about long term, right? So long-term sales. If I'm projecting sales to grow tremendously, my current facilities maybe can't handle that level of production. So I have to think about capital budgeting. Capital budgeting is how do I pay for long-term capital investments? If I have to build another factory or lease more space or open more locations, how do I pay for that? Capital budgeting helps us figure that out. So there's lots of moving parts to come up with this. When I did this in what I guess what we'll call the real world, we started typically around July. We kind of started working on it a little bit, and then really September, October, November, July and August were kind of it's kind of something that you had to work on a little bit. but then it was really September, October, November where you really hit it hard to put it together. So it took us a 5-month process, and we didn't typically have it finalized till early December. That it was okay, put to bed. Here's what everybody's going to agree on this. This is what our budget will be for the next year. So it takes a while. Obviously, the bigger the business, the harder it is to do. At USF, I will tell you that it takes a while too, because USF really uses a lot of people. So if you think of, like even in the Cleveland Center, we've got 3 programs. We've got the traditional undergraduate program, we've got the degree completion and MBA. Each one has a separate budget. So just looking at that one building, the business school has 3 budgets. Look at athletics. Every sport literally is a budget, and you've got a budget on top of that for sports administration. So just think about if you go to the School of Education, there's various budgets there, humanities, different departments in the university. So there's a lot of budget directors. It's like right around 50 people who are involved in putting together a budget that's sent to administration, basically the accounting department, where we've got a CFO and a controller, and they're the ones who are kind of putting it all together and overseeing the process. So a lot of people can be involved. So as we talk about the budgets and all those moving parts, all those pieces that have to fit together, very first thing you do is your sales, right? The sales budget. What are sales both in dollars and units, right? Typically it's first with units. How much will we sell? And then of course we should know roughly what we're going to charge for those units for the dollar part of it. So once I know how much I'm going to sell, I have to produce it. Right, so now I have to make enough units to be able to support my expected sales. Plus, you typically want to have an ending inventory requirement. You don't want to sell out, so you want to make potentially more than what you think you'll need just in case sales take off. You want to have enough units on hand. So typically, you want some kind of a goal for ending inventory. And so units to produced is basically what is my unit sales plus desired ending inventory minus what I already have, right? So if I've already got some inventory that's going to carry over from the previous year, I don't have to make that. It's already there. It's already done. So that's the formula to come up with how much I should produce. So next is direct materials. Now I know the units I want to make. Next is I have to buy raw material to support that. And you're going to kind of see a pattern with these formulas. So I expect to use X dollars of raw material, plus I have to have enough raw material on hand as a cushion, right? Typically most businesses want a cushion of leftover raw materials inventory, minus what I already have. So if I've already bought it in a previous year and it carries over to the next year, I don't have to buy it again. So it's basically what I expect to use for raw materials, plus a goal for desired ending inventory of raw material, minus what I already own. And that's kind of the pattern you'll see as we figure these out. Direct labor, basically, how many employees do I have? How many hours will they work? Do I have enough people to handle my production? What will that cost me? And overhead, just what I expect in terms of all those indirect and overhead type things. So my indirect labor, my indirect materials, and just the overhead for my production, my factory, and so on. All that stuff we talked about in the past. And then, of course, I need to make enough goods to sell. So I should have an ending finished goods inventory budget. Basically, do I have enough goods on hand to support sales? And once I've got that, then I'll figure out my cost of goods sold, which of course goes on the income statement. Then I have a lot of my administrative type expenses, marketing expenses. Obviously what usually happens with every business is every year you kind of have a marketing goal or a kickoff as you do your budgeting process. We have a level of sales that we expect. How will we support those sales? If we're going to grow our sales, how will we do that? Typically through marketing. I just met with our marketing department at USF. I probably meet with them informally over the phone, typically about once a month, but usually in the summer, and I had that meeting last week, is a formal meeting where we talk about, they tell me what their budget is. I don't budget my own marketing. Administration does that, and they carve out dollars for every program. They tell me what they want to do, what they're thinking of, and this year they're going to put some ads together, both radio and TV. They've already actually got them done, and which is, we already talked about that previously, of course. And so they showed me the ads. We talked about the cost, when they're going to show them, all that kind of stuff. So, but basically to support an enrollment goal was the marketing has to follow, because if you don't market, people aren't aware of your program, right? They kind of forget it exists and start to look somewhere else where they see advertising. Same thing with administrative. What will kind of that administration cost be? Not every business has R&D, but of course if you do, you should budget for that. And all those things, so your sales, your cost of goods sold, all of your administrative expenses, to then turn into your budgeted income statement. And then same thing with capital expenditures. Every business has a list of desired things they would like to invest in. If it's new technology, new servers, new computers, new software, new buildings, new locations, whatever that is, that's a part of the budget process also. And that's what USF goes through every year. It's you submit a list of here's what we believe we need for capital expenditures, and then you find out if you get it or not. You try to categorize everything and rank everything, because there's only so many dollars to go around, and you try to tackle the needs that are the most critical first, of course, and you kind of just go from there. So, but capital expenditures is how do we pay for long-term, more expensive items, long-term assets. Okay, then your cash budget. And I should kind of be saying that starting on page 381, they walk you through all these various budgets, and they show you those cornerstones within the chapter, those purple colored pages. And even if you don't walk through every single cornerstone and follow it through how they came up with the numbers, and you should, I think it's just a good way to kind of see the numbers, because they kind of show you on one page the setup of the problem, and the next page they show you how they got that number. It's quite often how they do it. But they also have a why. There's a dark purple within the purple area that kind of says, here's why we do this. Here's why this budget is needed and why we put it together. So I'll let you read those on your own. They're very self-explanatory and not that difficult, I don't think. So just go through those. There's several. There's ones I've been talking about. It was basically about a page per budget, roughly. But I do want to make sure I point out the cash budget, and that's kind of falls under the financial budget. The cash budget they begin to talk about on 396, okay, and detail plan that shows expected sources and uses of cash. Right, where does my cash come from? Where does it go? We've got 5 categories, basically total cash available, what are my cash disbursements, do I have a cash excess or deficiency? If I have a deficiency, then I better have some financing, and then what's my cash balance? Okay, so basically, where's my cash come from? Where does it go? Am I short? And if I'm short, where does that money come from? And so those same 5 things are right on the middle of 397. And they walk you through, in the very bottom of the page is this screen right here, kind of just the calculation to come up with your ending cash balance. So there is a Cengage Now problem. There is at least one that will deal with putting together a cash budget. So just kind of make a note that you'll want to be aware of that format. Of course, when you do it in Cengage, to kind of give you some structure to it anyway, it'll kind of be very self-evident, but just kind of understand, why that is. Obviously, we've got beginning cash. It makes sense that you add cash receipts to that, and you subtract that cash as goes away, right? So I subtract cash disbursements. I subtract a minimum cash balance. And the reason I do that is with business checking accounts, quite often businesses require a minimum cash balance, and if you fall below that, they'll charge you a fee. So let's just say I've got $50,000 in the bank, but I got a $10,000 minimum. Well, I really can't spend that, right? So that's money I can't spend. I mean, if I do, the bank's going to hit me up with a fee of some sort. So that's why they subtract a minimum balance. And potentially a bank doesn't have one, but if it does, you'd subtract that minimum balance. And then that gives us basically, do I have more cash than I need, or am I short cash? From there, I subtract repayments of principal. I had loans, I had a minimum cash balance back, I get my ending cash balance. So just be aware that's kind of this general format you'll follow when you do that in Cengage Now. Then a budgeted balance sheet. Basically, it says the culmination of all the financial events. If we achieve this level of sales, production, and all those things, here's what my balance sheet will look like based on basically my income statement is going to drive a lot of what this is. My production and my sales. So, and they actually also mentioned that on before I get too much into this, to go back to the cash budget, 399, page 399 has Cornerstone 8.12, and that's kind of the how and why of doing a cash budget. They got a good example there and the reason for it. And they show you what a cash budget would look like on page 400. And then just with cash budgets, I've been in businesses where we did them for a month at a time. The one they show you in the book is for a year, but they did it quarter by quarter. When I was in property management, I did that for 2 years. Every property that we had 35 properties that we managed, we did a monthly cash budget on every property, because some properties were kind of seasonal, and you knew that they were going to be full some months but empty other months, or not as full basically. And so the reason for doing a cash budget for a year month by month is just to try to plan out, are there going to be a month based on what we see here where we're going to have to borrow from the bank to have enough cash to pay bills and things like that. And so that's kind of the purpose of doing cash budgets. So you can do it monthly. The book shows an example. They just did it quarterly. It's really up to the business what they want, obviously. So a balance sheet example, the same one on your screen, is on page 401. And again, kind of the culmination of the budgeting process. Here, if we meet all of our goals, here's what our balance sheet will look like. Okay, and so just another example of a balance sheet there. Okay, so the shortcomings of the traditional master budget process, they begin to talk about these on 401. And this is what I've done. This is the process in having done budgeting for a couple different businesses and been involved with budgeting. It's always been kind of department. Every department manager was essentially a budget center manager also, and was responsible for any revenues earned by that department and expenses incurred by that department. It's kind of focused on your department. What does my department need for the next year? And so you don't necessarily look at other departments. You kind of focus on you, and you don't focus on the relationships between your department and everybody else in the company. And so that's kind of a downside of it. And the only way to really overcome that is communication, budget meetings, discussions, sharing of strategic plans, things like that. That will help. It's also static and not dynamic. By static, basically saying it doesn't change. It's developed for a single level of activity. So if my company expects to make 10,000 units of product X for the year, let's just say that's the only thing I make is product X, and I expect 10,000 units to be it. If I build a budget just based on 10,000, that's what we call a static budget. I'm just basically saying, here's what all my financial statements will look like if I sell 10,000 units. Okay. Also, you look at it from an incremental approach, and what you typically do is you look at last year's and make adjustments to it. So that's part of being a budget director was kind of as you get a kickoff meeting for the budgeting season, is you sent reports to everybody basically saying, here's your last budget, here's your budget this year, how so far, here's what it was the last couple of years, to kind of give everybody a perspective, and then kind of saying, okay, here's what I've traditionally been budgeting, I'll just make some tweaks to that. And that's that incremental just means change. When you hear the word incremental, just think change. I'll just take what I've been doing, make a few minor adjustments based on inflation or a few things that I know, and I'll turn it in. And the downside of that is you don't maybe put the thought into what that you should. You kind of just get used to the same old, and don't make changes to it. So there is some downside to that for sure, but it's easier to do, but people don't dig into it as deeply as maybe they should and try to justify expenses. So an alternative to that is something called the zero-based budgeting. And static budgeting is on 403. Zero-based budgeting is on the bottom of 403. Zero-based budgeting is basically saying just because you were allocated dollars for something last year doesn't mean you're going to get it again. You have to literally go through and justify everything every year. It takes a lot longer to accomplish, much more time intensive. Not every business has the resources to devote that much time to it. The book talks about kind of an alternative would be to only do zero-based budgeting every 3 to 5 years, just once in that time frame because of the time requirements, or when maybe a business has a reorganization or some change to their operations, maybe that's a good time to kind of blow everything up and think zero-based for a year. Then we'll go back to doing incremental-based budgeting for a while. So there's alternatives to it, but just know what those terms are. I'm sure those terms are going to come up on a quiz or a test, so just be prepared for that. And of course, another shortcoming is that it's more results-oriented and not process-oriented. Okay, basically it says managers concentrate on resources and may fail to see a link between resources and output. So you kind of focus on, I guess what we'll call tunnel vision. You kind of just think about what do I need to accomplish my job, resource-wise, dollars-wise, without thinking of the bigger picture. Okay, so again, a static budget is based on one level of activity. So another alternative to a static budget is what we call a flexible budget. I'll probably just say the word flex budget a lot. And they give a really good example of some flex budgets on 405. Now I will tell you that in Cengage now for your homework, there is nothing involving flex budgets. It's all going to be static budget based. I want you to be aware of flex budgets. There'll be some questions on the test about flex budgets, potentially a little bit of a number cruncher here and there regarding flex budgets also on the test. But there's nothing in Cengage now. But if I give you a couple of questions that are number crunchers on the flex budget, I promise you they're not going to be like complicated. So don't worry about that. But just be aware of flex budgets, and we'll talk about what that means. So a flex budget provides expected costs for a variety of levels. So I said, if I make a static budget based on I'm going to sell 10,000 units of product X, well, maybe I could build a budget that says, what would my budget be if I sold 8,000 units or 12,000 units? I can just come up with various levels and say, what will my total master budget look like based on different levels of activity? And of course, with the magic of Excel and things like that, you can connect your budgets together because they're all interrelated. And if you set it up well, you can have some inputs where you just change a couple of your factors that go into your budget, a couple of your assumptions, and they would just roll through and produce a new budget. So that's a good budget will do that. You'll have set up in Excel that you have some kind of an input with your assumptions, and every time you change an assumption, you can go and say, okay, how's my revenue now change? What's my net income change by? And so on. So a flex budget, then total budget production costs increase, obviously, as output increases, right? And they would decrease as output decreases. Okay, so it's a flex budget. They also say variable budget, kind of means the same thing. Now the issue is sometimes budget variances are caused by those different levels of output. Okay, so sometimes a budget can be misleading when we're looking static versus, if my static budget said 10,000, but my actual came in at 12,000. I produced more than I thought I would, so I'm going to have a lot of budget variances that might be negative, but they're negative for a good reason. I was able to produce and sell more product than I thought I would. And so a flex budget kind of tries to erase that and take that out of the equation. Okay, and so a flex budget is a good way to help us measure efficiency and effectiveness, right? Because efficiencies are going to come in where I budget certain things, right? I'm going to say, I expect it to cost me $20 to make product X, okay? But if I sell 2,000 more units than I planned for, I'm not going to be able to see that in my budget and my variances very well. It's not going to fall through very well. But if I do a flex budget, I'm going to be able to figure out exactly what it cost me to make my product actual versus that budget, and the difference will help me measure my efficiency. And the effectiveness, basically saying how effective were the managers at achieving their goals. Okay, so efficiencies and effectiveness. So a typical budget report would look a lot like this. So when I say variance, that's just simply the difference between an actual number and a budgeted number. And the F means favorable, and the U means unfavorable. Okay, so for example, units produced. We produced 3,000 on a budget at 2,400. So the favorable variance is I was able to produce more than my budget. Okay, well, because I produced more than my budget, I automatically am going to get unfavorable materials and labor, right? I made 600,000 more units than I thought I would, so obviously I'm going to spend more on direct materials and more on direct labor. It's just the way it's going to be, and therefore my overhead's going to be higher, and so on. So a lot of things here are unfavorable, which is what we expect if we built 600,000 more units than planned for. Most of my variances will be unfavorable. I happen to have somehow we got a good deal on power. Apparently power rates went down a lot. That was favorable. And we were able to trim our supervision costs a little bit, so that was favorable. But basically everything else was unfavorable because of the extra production. So, this is good information, right? But it doesn't help me measure the efficiency of what's going on. And so that same info is on the bottom of 405, just so you know. So what's more useful is to look at it from this perspective, and this is on page 409, is, okay, here's my actual, okay, 3 million. That's what I really sold. My static is way over here, what we looked at previously. But now what I do is I say, okay, let's build a flex budget based on 3 million units produced. So what would my direct materials be, my labor, all those things be based on that level of output? Okay, that gives me a much better meaning in terms of efficiencies. Okay, so my flex budget variance is column 3. Columns 1 minus 2 is column 3. And so I set my units produced exactly, budget and actual, I set them to be the same. And I basically say if I make 300 million or 3 million units with my static budget assumptions and adjust that to 3 million, what would that be? Well, my direct materials cost was 780. So now look at this. So based on this, I can see that I was not efficient in my direct materials. While I made 600,000 more units than I originally budgeted for my static budget, and when I compare those assumptions into a $3 million unit number, I can see that I will have an unfavorable variance of $147,000. So I was not efficient in my production of my goods for whatever reason. Maybe it was just that materials costs went up way higher than we anticipated. Maybe whatever that raw material is, the prices fluctuate and they just went crazy and we didn't budget for that. That could be the answer. The answer could be some skilled labor left us. They went to a competitor. We had to hire new people. And so therefore they weren't as good at their job and they wasted material. Then maybe that was the answer, right? But at least if I have this variance, if I'm in management, I can say, why did this happen? What happened? What's the issue here that we did not anticipate that caused this unfavorable variance? And now I can ask questions and help me understand the business better. That's the whole point of budgeting, is these variances give us a point to ask questions and understand the business and management. That's that part of that control and feedback. So if I'm doing this monthly, right, I can figure this out right away and make adjustments so that my full year's data is not as impacted as, I can make those fixes sooner rather than later. So that's the point of kind of showing you that flex budget right there, is that information is a little bit better. I still have then I have my volume variance over here, which is column 5 is column 5, which is columns 2 minus 4. So my flex budget minus my static budget. And so now I've got just volume variances, right? Well, yeah, my units produced is higher, so therefore my materials cost is unfavorable, therefore my labor is unfavorable, my supplies is unfavorable, and so on. So yeah, that makes sense because I produced so much more than the flex budget came in so much higher than the static budget, that yeah, I've got all these unfavorable variances. That makes sense. But really what tells a story is column 3, that flex budget variance. That's where we measure efficiency, or in this example, lack of efficiency. Just so you know, I'm kind of skipping activity-based budgeting. I'm just not going to cover that topic, so don't worry about questions or anything like that. It's just a couple of pages in the book, so don't worry about activity-based budgeting. I'm not going to ask you questions about that. Traditional-based, here, let's see. So I'm going to skip that, skip that, skip that, skip that, and then get down to here, behavioral. And this is probably, this has been a challenge at every business I've been at, is that the behavior is sometimes people get in that trap of, if I don't spend my budget, I won't get it next year. Or if I don't start out big with my request, my initial budget request, I'm not going to get what I need. And that's can be managed by a business by saying, just because you didn't spend your budget this year doesn't mean you can't ask for the same number next year. Or just literally turn in a realistic budget. Don't ask for more than you need, knowing we're going to cut it. Just start out with a realistic budget. And so you can communicate that. You can kind of hopefully fix that a little bit. But quite often, that's what people think. It's human nature, really, right? We're all human. That's kind of how we think. If I don't ask for it, I'm not going to get it. So I'm going to ask for more. And if I cut a little bit, I still got what I need. Or if I don't spend this year's budget, I'm not going to get next year's budget. So that can all be managed. Budgets are often used to judge the actual performance of managers. I've been in businesses where if you come in under budget, you get a bonus. You get some reward for that. Okay. And that's a good thing. That's not a bad thing. But that means your budget should be realistic, and it also should be achievable so that it has a motivating goal. I've been given goals I knew I'd never meet before. It's not motivational. It's like no matter what I do, I'm not going to ever meet that goal because it's not realistic. So that did not motivate me. In fact, it's kind of a demotivator. So you have to be careful about that too. If you are going to reward people for meeting goals, the goals better be achievable. Okay, and so goal congruence is a big one, right? Alignment of managerial and organizational goals. So the organization has to be good at communicating its goals, saying, here's what we want, here's what we expect to happen, here's the big picture. Does everybody understand the big picture? Yes or no? Yes, you understand it. Okay, let's go. Let's do a budget from that. If you don't understand it, let's ask questions, let's figure it out. And so now your goals have to fit in the big picture, and that's a good thing, right? So dysfunctional behavior involves individual behavior. It's not that is in conflict with the goals of the organization. So maybe just, I'm out for myself, I'm looking out for me, I don't care about the big picture, I just want to get mine. Obviously you got people who think like that. You got to be careful about that. So a good budgetary system, and this is on page 415, and the behavioral dimension was on 414, what we just got done talking about. And then 415, there's quite a few pages regarding the characteristics here. There's about about 3.5 pages that go with a good budgetary system characteristics. So frequent feedback on performance, right? Monthly is a good time to do that. There should be a monthly, here's how we're doing, here's what your budget is. Monetary, non-monetary incentives. So don't focus on incentives always being financial. Maybe they could be vacation days or the company throwing a party, just whatever it is, just something. Participative, right? Everybody has a say. It should be, the best budgets are from the bottom up, not top down. When you're told, here's your budget, like it or not, here it is, it's not motivating. But if you were involved and there's a two-way communication when your budget was put together and completed, and you understand why your budget is what it is, and it's achievable, it's realistic, now you're motivated. You want to meet that. Okay, so participative and realistic kind of go hand in hand. Controllability of costs. There are costs that can be controlled. So if you've been assigned a budget of whatever dollars, the decisions you make will control those numbers. Sometimes you're allocated numbers that you have no idea what they are, and you're just stuck with it. Okay, but if the decisions you make, if the actions you take control costs, now it's participative, now it's realistic. Those are good things. And then multiple measures of performance. A budget shouldn't be the only thing that's measuring the performance of a manager, right? There should be more than just a budget. There's lots that go into the effectiveness of a manager. The ability to manage a budget is just one of those pieces to the picture. It's not the only piece to the picture, or piece of the puzzle, I should say. So just be aware of that. So while it should be a measure of performance, it should not be the only measure of performance. So businesses that get into that trap are probably not necessarily effectively managing the managers very well. I would say that. Okay, so lots of information. I like this chapter a lot just because it's what I did for so long. So as you go through the chapter, make sure you're stopping to look at the purple pages with the various cornerstone examples. When you get to the back of the chapter, on page 420 is a list of key terms. I would recommend reviewing those before you take the quiz so you've got a good idea what they all mean. There's a review problem if you want to do it on page 420. Discussion questions on 423. Those are a great way to kind of test your knowledge of the chapter. because I posted those answers. They're in handouts. And so after you study the chapter, you could read a discussion question to yourself, jot down some highlights of what you think the answer are, think about the answer in your head, then go read it. Was I on track or was I not on track? If I was on track, awesome, you know it. If you weren't on track, then go back and reread that section of the chapter and make sure you have a good feeling for what they're talking about. Then the end of chapter cornerstones start in the very bottom of 423. There's a lot of them. The ones that I would ask you for sure to go through, let me give you a list here. So the answers are in the handouts again. Go through 8.1, 8.2, 8.3, 8.4, 8.5, and 8.6. There's ones a lot like that you'll be doing in Cengage. And then also do 8.12. That's a cash budget example. There's one of those in Cengage too. Those are the ones that I would say if you go through those on your own, check your answer to the answers I posted, I think you'll be in great shape. And then obviously I've assigned you several in Cengage now. The ones I assigned you in Cengage now are kind of just pieces like a sales budget, a direct materials budget, a purchases budget. There's one for a cash budget. I didn't assign every single potential one because there's so many that have been just too much. And then the required problem for Chapter 8 is, I'm trying to get to it here, it is problem 8-36, which is on page 438 of your book. That's kind of doing the big picture. So that one is, that one you'll do a sales budget, production, direct materials, direct labor, overhead, selling administrative, ending finished goods inventory, cost of goods sold, and budget income statement and cash budget. So it is kind of a long one, but it kind of ties it all together. I wanted to give you one like that because now you can see how all the various pieces fit in together into the big picture. So that's why I gave you that one. So I think you'll find this chapter fairly straightforward. It's really not too bad, but I think the key is that you review the terms, review the discussion questions, and work on some of those cornerstones and check your work to the answers I've given you. And then, of course, don't forget about in Cengage now, you've got the study problems you can do every week, kind of just on your own. I don't require that you do them. And I would say if you're feeling uncomfortable with the material, then you probably should do them. But if you feel like I know the material pretty well, then you probably don't need to. It's kind of just an individual decision how much time you spend with those. So I'll let you decide that. And we'll wrap up Chapter 8. So thank you very much. I think you'll enjoy the chapter, and as always, if you have questions, just let me know. Thanks.